So let's talk about something called private credit. You might not hear about it every day, but it's this massive, multi-trillion-dollar force that's been quietly rewiring, well, the entire financial system. It's changing the very answer to the question of who funds the businesses we all rely on.
And believe me, the stakes here are absolutely massive. I mean, look at this number. Over the next 2 years, a staggering $3.2 trillion of corporate debt is coming due. That creates this huge, and I mean urgent, demand for new financing.
So that naturally leads us to the big question, right? Who's going to step up and fund all of that? For decades, the answer was super simple. But today, well, that answer is being completely turned on its head.
Okay, so to really get what's happening now, we have to rewind a bit. We've got to start with the story of the Great Retreat, of the most traditional lenders of all, the banks.
You know, for the longest time, it was a given. If your company needed a loan, you went to a bank. Simple. It was basically the bedrock of business financing. But then 2008 happened, and the global financial crisis triggered this seismic shift that honestly changed the game forever.
So this timeline here really lays it all out. The huge regulatory reaction to that crisis. In its wake, you got rules like Dodd-Frank and Basel III. Now, these were all designed to make the system safer, basically by forcing banks to hold way more capital and take on a lot less risk. And that move, right there, fundamentally changed their entire business model.
And what was the direct result? A massive, massive consolidation in the industry. I mean, just look at these numbers. The number of U.S. banks literally plummeted by more than half. And the ones that were left, they got bigger, way more conservative, and just less willing to make certain kinds of loans. So what happens when the biggest players pull back? You get this huge funding vacuum. As banks got more cautious, thousands of perfectly healthy, medium-sized companies, the real engine of the U.S. economy, were suddenly left scrambling for cash. And as they say, nature bores a vacuum, and so does the world of finance.
And right into that void, a new and incredibly powerful player stepped up, kicking off what a lot of people are calling the golden age of private credit.
So what is this stuff anyway? Well, at its core, we're talking about direct lending. And honestly, it's pretty much what it sounds like. You've got these non-bank institutions, think asset managers, private funds, lending money directly to companies, totally bypassing the whole traditional bank loan process.
And when I say growth, I mean it has been absolutely explosive. We're talking about a $1.8 trillion market today, and that's projected to hit $2.3 trillion in just a few years. Yeah, this is not some niche corner of finance anymore. This is a dominant force.
So why are so many companies flocking to these new lenders? Well, when you put them side by side with banks, the picture becomes pretty clear. Direct lenders are faster, they're way more flexible, they've got a much higher appetite for risk, and they tend to build these long-term partnerships, It's not just about a single one-off transaction.
I love this analogy because it just hits the nail on the head. A bank loan is kind of like buying a suit off the rack. It'll probably fit okay, but private credit? That's like going to a bespoke tailor who crafts a financial solution that is perfectly, uniquely designed for your company's situation.
Okay, so up to this point, the story seems pretty simple, right? The old guard is getting pushed aside by a nimble new challenger. But this is where things get really interesting and a lot more complicated.
Yeah, that whole narrative of banks versus private credit, it's super compelling, but it totally misses a huge hidden piece of the puzzle. The reality is that these two worlds are deeply and pretty surprisingly tangled up with each other.
Check this out. A recent paper from the Federal Reserve Board revealed this wild twist in the story. It turns out, as banks lend less to companies, private credit funds step in to fill the gap. But how? By borrowing more money from the very same banks they seem to be competing against. Wild, right?
So what you've got is this kind of hidden chain of command for money. First, a bank lends a line of credit to a private credit fund. Then, that fund turns around and lends that exact same money to a business, but at a higher interest rate. The banks are basically acting like wholesalers for capital. And guess who pays the markup at the end? The business that needs the loan.
So this all begs a huge question. How are the banks handling this new world, where they're both competing with and bankrolling the private credit market? Well, let me tell you, they are not just sitting on their hands.
What we're seeing is that banks are taking this really sophisticated, four-pronged approach. First, they're competing head-on, trying to improve their own lending game. Second, they're leaning in and lending to these private credit funds. Third, they're partnering up, forming joint ventures. And finally, they're offering all the essential back-office services, custody, payments, you name it. Basically, they're finding a way to get a piece of the action no matter which way the deal flows.
So, what's next? Where does this incredibly fast-moving market go from here? Well, the ambition of private credit now goes way, way beyond just funding corporate buyouts.
And you can really see the next frontier when you look at where the smart money is going. I'm talking about sovereign wealth funds, the biggest investors on the planet. And guess what? It's not just corporate lending anymore. They see huge opportunities in funding massive infrastructure projects and big real estate deals. So this isn't just about replacing bank loans anymore. It's about financing the very bones of our economy.
All of this brings us to our final and maybe most important point for today. The one big question you should really be asking about this new, rewired financial system.
And that question is this. In this new, more complex, and let's be honest, much less transparent system, where the lines are all blurry and the biggest deals are done behind closed doors, who is actually holding all the risk?
And figuring that out is absolutely critical. Why? Because this entire multi-trillion-dollar ecosystem was built during a time of relative economic calm. It has never, ever been truly stress-tested by a major prolonged downturn. So while the rewards of this new system are pretty obvious, the full extent of its risks, well, they're still hidden, just waiting for the first real crisis to drag them out into the light.
This is not financial advice.